Morning, everyone. My name is Anthony Baker, and I'm the Director of Pay and Benefits. Welcome to our third series of workshops and seminars on your benefits. Today is your Thrift Savings Plan presentation. I know that you will get a lot of information today, and it will be helpful as you go through your time here at CMS and lead it into your time of retirement. One of the things we always like to say is that the day you retire is not the day that you start. You start when you started here in the federal government. So if you haven't started then and you're still here and you have some time, use it wisely, and the plan will show you how you can make the max of your money for retirement for the future. So again, welcome you to the third of our 9 seminars, workshop seminars on retirements and benefits. Have a great day.
All right. Good morning, everyone. We thank Tony for that wonderful welcome. I hope everyone feels welcome. And I just want to echo that. Welcome to all of you for our TSP seminar on today. We know that you're going to learn the differences between the Roth TSP and the traditional TSP. So sit back and relax and just glean all you can get on today. We have a wonderful speaker on today, and she's going to do a thorough job, and so you will learn a lot. You will take away a lot on today. So before we get started today, I have a few announcements that I want to lift up before you. By the way, my name is Paulette Holmes, and we wanted to lift up a couple of things to you before we get started. And the first item is, if you haven't done so already, please sign in for us before you leave on today. We have the sign-in sheets right out front at our tables in front of the auditorium. The second item is the survey questionnaires that you all received in your handouts. Please complete those before you leave today and return those in to our benefits specialists who are sitting outside on the tables. We need you to get those back to us. And for those folks who are conferencing in, if you need to get a copy of the survey questionnaire, you can request it from the CMS HR Center Help Desk, and the email address is hrcenter.helpdesk@cms.hhs.gov. Again, that's hrcenterhelpdesk@cms.hhs.gov. And what we do when we get the questionnaires, we review them, and whatever comments you all have, we try to see how we can improve, make improvements. And one of the things that we've done is someone said that we should shorten the survey questionnaire to 1 page. So we've done that, as many of you all will see. So we really do try to make changes and make improvements. So please fill out the questionnaires because we read them. The next item is the phones. Some of you just remember during the seminar, we're going to ask you to please put your cell phones on mute or turn them off during the presentation, because we will be YouTube live streaming. So please help us to try to prevent as many distractions as we can. Put your phones, cell phones, turn those off. And for those folks who are on the phones, we're going to ask you all to make sure your phones are on mute. Now, your phones were automatically muted, so we won't have any distractions. However, the presenter throughout this seminar, the way she may conduct the questions may be a little bit different, because in the past we waited to the end. So she may decide to take questions after each segment. So for those of you whose phones have already been muted at home online, just hit #5, and that will unmute your phone. But just remember, please mute it back so that we can eliminate as many distractions as we can. And the last item that I had was I wanted you all to know that we were live streaming again on YouTube, CMS YouTube. Therefore, you will be able to look at this presentation again. We previously sent out an email broadcast with the information to access YouTube, or you can contact the HR Center Help Desk at cms.hhs.gov, and we can give you further details on how you can get the link to the YouTube, okay? And the last thing I want to lift up for you all is please check out our HR Pay and Benefits webpage for information on upcoming seminars. As Tony indicated, this is the 3rd of 9, so we have 6 more to go. So you all can check out what the schedule looks like on our benefits, Pay and Benefits webpage. So now I'm going to move on to the introduction of the speaker. Today we have with us Ms. Paula Austin Gradwell. She's with the Thrift Savings Plan. Ms. Gradwell joined the staff of the Federal Retirement Thrift Investment Board in January of 2002. Her duties include conducting agency training sessions and employee briefings, and responded to telephone written inquiries from agencies and participants. Ms. Gradwell was previously employed with the Department of Defense, the United States Air Force, for 11 years. She worked in a variety of positions, including relocation assistance. She was a family life education, and she was a personnel financial management at the Air Force bases, both in Europe and in the United States. Ms. Gradwell holds a Bachelor's of Science degree in education from the Florida State University, and she holds a Master's of Education degree from the University of South Carolina. In addition, she is an accredited financial counselor. She's a certified housing counselor, a certified family life educator, and holds the designation Retirement Planning Associate for the International Foundation of Employee Benefit Plans and the Wharton School of the University of Pennsylvania. So I introduce to some and present to others our speaker for today, Ms. Paula Austin Gradwell. Let's give her a CMS warm welcome.
Thank you. Good morning, everybody. Thank you all for coming. I have a space that I'm allowed to walk in here today. And again, when we do take questions, we need to make sure that you go to the microphones because this is being streamed so people can hear you and hopefully everybody can hear me. You do have a handout here, so you have some slides. And we'll be going through them. Some we're going to spend a little time on, some we're not going to spend a lot of time on. Some you can take back to your desk. You can see what applies to you, what maybe doesn't. But we're talking about your TSP. How many in here are CSRS or offset? Still have a few folks in the older retirement system who all look younger than I am. Okay? So when I talk about the old retirement system, I'm not talking about old people. The rest of us are FERS, is that correct? Who's been hired FERS since January? Who was hired in 2013 FERS? Anybody? Okay. So your FERS portion is a little bit different than the rest of us in this room. And has anybody been hired this year FERS since January 1st? No newbies here? Congress changed the FERS thing again. So when we talk about TSP, I can't really address your Social Security if and when you're eligible for that. And I can't really address what I call your pension that you're going to get from OPM. That's your CSRS portion or your FERS portion. So you're going to hear me say pension, and I mean OPM portion, because TSP does offer an annuity, and I don't want those two pieces to get mixed up because they're totally different kinds of issues for all of us in this room. Okay? Now, everybody who has a TSP account was open the first day we got a deposit from your payroll deduction, or if you were FERS, your agency put in 1% to at least open your TSP account. Now, a couple of things that are not on these slides that I'd like to share with you, those of you who like to take notes, because you're going to hear me use some terminology, just like you all have terminology for your agency, we have some for us. So I just want to make sure that it makes sense to you, and when you hear it later on, you'll know what we're talking about. For TSP purposes, everybody in this room is only one of 3 statuses. We're active. That means we are eligible to be in a basic pay status. Once we get our last SF50, we are then separated for TSP purposes. However, we won't know that for approximately 1 to 3 pay periods after you separate from service, because your payroll office tells us we don't get your SF50, it comes electronically. So you're active, you're separated with whatever that date is on your final SF50, or you're deceased. You aren't going to know it, I hope. Because the bottom line with that is, when you all got your annual statements, this information, employment status, was on there, and sometimes you have somebody who does a data entry, and they end up moving you for some reason by accident, not very often. One day you're in TSP as being active, and the next day you're deceased with a date. So you need to go breathe on somebody in HR. Okay, to let them know you're still here. So you're active, you're separated, or deceased. 2 things in life are sure. Everybody knows what those are. You're all sitting close enough to somebody. If you don't, they can share it with you. Okay, we've got taxes and death, not necessarily in that order. Okay, now TSP is a defined contribution plan. We need to know that because my FERS or CSRS pension portion and Social Security, if I'm one of those folks who's eligible for Social Security, those are defined benefits. And how it works out by the end of my career for those 3 pieces is different, and taxes may be different. So you've got 2 pieces that are defined benefits, your pension and your Social Security, and then your TSP, which is a defined contribution plan. You're going to hear me say TSP, defined contribution plan, or we are a 401k-like plan. And I put the word like in there because 401ks, the basic legislation was there before TSP came about. Congress created us, so you know what that means. We look a little bit different. However, all 535 people up on Capitol Hill also are eligible to participate in TSP because they are federal employees also. So they are part of this plan, or we are part of them, and a good portion, significant portion of what we do is legislated through the FERS Act and or Internal Revenue Code. So it's not a lot of policy that we make up as we go along, which a lot of people say, why does TSP do this? TSP is not necessarily the only the only plan that does something, but if we are, it's because it's through legislation in many cases. So we will try and go over some information today, hopefully that will be helpful for you, and we'll see what's going on again. Saving for retirement, your contributions. We have 2 specific separate, 1 or 2 slides for FERS, some information on CSRS, and there's only these 2 or 3 slides, and then after that, everybody in this room is on the same sheet of music. It doesn't matter what your retirement system is. Okay? How are we investing? Everybody has to choose. We are a self-directed plan. That means I have to make my own decisions. I'm a FERS employee. I came very late to the federal government, and if I don't take full advantage of my TSP, I could work till I die. And some of us know this if we've been around at least for a couple of years. So the younger folks in this room, when we're sitting here poking you like this, there's a reason. You don't want to be working as long as some of us are because we came late to the government. We'll look at loans and in-service withdrawals. A lot of this stuff, especially at this end, also IRS and legislation drives the train, Internal Revenue Code. We will also be looking at when it comes time, very briefly, if I have separated from federal service, what I can do after I separate with my TSP account, because I think there's a lot of misconceptions out there about what TSP is and what I can do with this account, whether I'm actively employed or whether I'm separated. And then when I die, I used to say if we die, when I die, if there's still money in my TSP account, because this is a defined contribution plan, this is your account. And hopefully, if there's money in your TSP account when you die, it's going to somebody not only that you know personally, but that you love. And that's not TSP. This is your account. It's going to somebody you know. Okay. So hopefully we can look at a lot of these things. We've already said we're a defined contribution plan. This is not for short-term savings. I think a lot of people hear us say thrift savings plan. We're not the bank. We're not the credit union. This is for the long haul. This is for down the road when I don't want to have to show up 8 to 5 or whatever those hours are anymore. This is to help take care of me. And as a FERS employee, it's incredibly important that we take care of this. So we are not set up so that it is like a private sector brokerage account where you can go out and move money anytime you want, 6 times a day and market time. And we also don't have a lot of what I consider non-mainstream investment kinds of things. And we'll talk about what we have and why we have them as we go along. Okay, how much am I going to need for my retirement lifestyle? Everybody's going to be different, okay? We've got some young folks sitting in here, and I'll start right here. And he's not going to be out of the workforce for what, 30 years maybe?
Lottery, then.
Longer?
So maybe I'll win the lottery.
Lottery? Okay. He's going to win the lottery. He'll take us all. How's that? How many of us are going to get that huge inheritance? Mom and Dad are living longer, so are Grandma and Grandpa. So that and the lottery are, real long shots. But in the meantime, most of us are going to be here for a while. So how much time do you have left to save for when you're going to walk out the door? How many of you are actually going to leave this year? Nobody's going to hold you to it. Nobody's taking your picture. Okay, a couple of you are going to walk out the door this year. Okay, congratulations. How many of you would like to walk out the door this year? Okay, so you kind of have to look at this. Okay, and I'm probably going to beat all of you because I have something like 13 days left, 12 days left, something like that. So I've done this long enough, folks. And you want to be able to be in that position at some point in your life and not have to say, how much longer am I going to have to be here? So again, we will look at some of these informational things. Now, benefits of TSP. There's no minimum investment. Your first contribution that's sent by your payroll office is going to be opening your account. That starts your contributions, whether it's your money or whether it is your agency money or some combination thereof. We have extremely low expense ratios every year. Some of you follow this. Some of you have no idea what the expense ratio is, how much it costs you to have TSP manage this on your behalf. We are paying ourselves first by having this money deducted from our pay. And that is one of the keys for these defined contribution employer plans, of which TSP is one. I can only contribute while I'm in a basic pay status. Once I separate from an employer, and in this case, the employer is the federal government, I can no longer contribute. It's not a TSP rule, it's a defined contribution plan rule. How many of you worked in the private sector, had a 401, 403, 457? So a lot of this stuff is going to sound familiar to you. Now that you're no longer with an employer, you can't contribute anymore. Now, in the FERS Act, it also says that if I get a bonus, a cash award, for most of us, overtime, sick leave, annual leave, none of that can go into your TSP account. That's the law. So if I take a buyout, I don't know about your agency, but almost every agency every couple of years does the VERA VSEP, the buyouts, and you get the lump sums if somebody walks out the door. None of that is eligible to come to TSP by law. So it's strictly whatever is my basic pay, and in almost everybody's case in this room, basic pay includes locality pay. And that's it. That's the only way I can contribute directly to TSP. Now, I dollar cost average. We hear about dollar cost averaging. You know, sometimes the share prices are here, sometimes they're here, sometimes they're somewhere in the middle. But we are contributing biweekly. Most of us, this year it's 26 times. Some years it's been 25, 26, 27 pay periods. That's what we're talking about dollar cost averaging, so that money's going in every single pay period for us. And it's not, I have to worry about it because I have told my employer, my agency, and that I am going to have X amount, either dollars or percentages, deducted so that I can have these contributions come to TSP. We, since May of 2012, have offered the Roth bucket option in TSP. Okay? Most of you who were in before then, the only thing a lot of us have are traditional tax-deferred dollars in our TSP account. And if we've been in a long time, the biggest portion of our TSP balance is traditional tax-deferred dollars, because we've only had a little less than 2 years to be able to contribute to the Roth bucket if we chose to do so. We do have diversified investment choices, but it's strictly do-it-yourself because that's the way this plan was set up. By law, we cannot give investment advice. So we can certainly share information with you, we can answer your questions, but we cannot actually provide the advice. Now, this gentleman who's going to win the lottery, his lifestyle for his retirement is going to be probably a whole lot better than this lady's and mine, is the short answer. Because if he wins enough in the lottery to be able to walk out the door before what we would call separation date at whatever the age is, then he's probably going to have a lot more to spend and not have to worry about it at all. Again, if he doesn't win the lottery, how much time does he have to save? How much time does this young man have to save? A lot. But what is the key for savings? And we keep seeing this all the time, and I think a lot of people are not, this is saying forward and it's not, there we are. There are 3 charts here. I'm not going to spend a whole lot of time on it, but this is the pay yourself first, this is the dollar cost averaging, and this is the magic of compounding. We picked 3 folks here, and we used some scenarios. We know they're not going to be exact, but we said they came to the federal government at 27, they're going to work for 30 years and walk out the door, they're going to separate. They contribute. They have a career path, a GS 5 to 11 in this particular one. They contribute only 3%. This is for FERS. That means their 1% is going in, and a biggest portion of the match for which they would be eligible is going to also go in. And if you look at this, if they don't touch it for another 10 years after they walk out, which could in reality happen at age 57, notice what happens to the actual compounding of their money. It actually doubles in that last 10 years with a 7% rate of return. And historically, since TSP began in 1987, you have had the possibility of a 7% return if you guessed right on where you put your money, even in those down years. So it's possible. It's possible for a good number of us. The next one basically shows the same person. They're getting their full match. They're putting in 5%. They're going from the GS 5 to 11. And notice that there's a $400,000 increase with strictly compounding by contributing 2% more and getting the full match of the additional 1%. And then the last one basically shows somebody coming in, they have a higher career path progression. They go for the first 10 years 5, then they do 10%, then they do 15%, and this almost doubles from everything. If we all knew this when we started out, and it's not putting in a heap of money. Now, a lot of us, when we start out, since about 2010, new employees have been automatically enrolled in TSP. Those of us who've been around for a while, you know, how many of you remember you had to wait? You had to wait before you could contribute, and you really wanted to. Well, we had to wait. And some of us had to wait at least a year. Congress changed the rules about 4 or 5 years ago, and so new employees or rehires who walk through the door are automatically enrolled, contributing 3% of their basic pay. Now, those new participants can opt out, but at least 3% is, you know, is signing them up. They can choose not to, but at least 3% is going to go in. So it starts their TSP life. Okay. How much did it cost to have us manage your TSP account last year? Anybody? This young lady? Pardon me? You don't know. That's fine. This lady doesn't have any idea, which is perfectly fine. How much did it cost you?
Don't have a clue.
Don't have a clue. Okay. Anybody? How many of you got an annual statement from us? How many of you read it? Oh, the answer was on the annual statement. So if you look on the bottom of the very last page on your annual statement, it showed all 10 investment funds, and it said by fund how much it cost each of us to have TSP manage those funds for us for 2013. Now, those numbers have changed almost every single year. They've never really stayed the same, but the key for TSP expenses is the fact that they are extremely low. This is from the day your account opens until the day your account ends. Whatever that expense ratio is in that calendar year is what it is for everybody. So what we did was we had a talented young lady in our office who went out here and took a quarter and 4 pennies and took a picture of it on her cell phone for us and put it against 401k's average in the private sector, and I get to basically keep $8 more per $1,000 in my TSP account to compound for me instead of paying it out for somebody to manage my money. Now, part of it is because it's economies of scale. We have 4.7 million participants, and that's a lot of folks. We're the largest defined contribution plan in the country. We're a federal agency. And the reason it does cost us something to have somebody manage our accounts, which is TSP, is after Congress created us, we are a federal agency with no tax dollars to operate. We are self-sufficient. That means all 4.7 million of us are participating in taking care of this. So it's a very low expense ratio. We have one fee, and that's it. And that fee is if we process a loan while you're actively employed, you choose to have us process a loan, there's a $50 upfront loan processing fee. Otherwise, there's no additional costs. Long-term effect of this is basically I get to keep about $70,000 more if I had $50,000 and could let it sit for 30 years and never put another penny in. I get to keep that much more of my money, again, with the compounding. We do offer a lot of planning and tools. How many of you actually use the website, go out there, go into your account, look at the stuff on the home page? We now have YouTube offerings out there with little vignettes about very specific topics about TSP. We're on Twitter. So there's a lot of things that you can find out here. And we do have a lot of calculators and planning tools along here. How much should I save? A lot of people at the end of their career start looking to see what their pension's going to be from OPM. They're looking to see what Social Security is if they're eligible. And they start plugging in what their TSP account is. this is something that maybe even at the beginning of your career you could start looking at some projections to see what's going on out there. Now, everybody in this room, we have no more open seasons. I talked to about 3 people yesterday where I was out somewhere else, and they said, oh, I'm contributing the max. Do I go out at open season and do this? First of all, we haven't had open season since July 2005. So open season is when you want to start, stop, or change. What is your employee page that you go to? Do you go to Employee Express? My Pay? You go to My Pay, you start, stop, or change. You choose a percentage or dollar amount for the elective deferral contributions, and your payroll office, which is DFAS, is going to start, stop, or change whatever you suggest or whatever you request no later than the next full pay period. So if you went in today, it may not pick up until the next pay period because that is the way the system is kind of set up. Now, everybody can contribute. We also have no percentage limits anymore. I keep hearing about percentage. You know, I'm doing the max. I'm doing 10%. That's not true anymore. Since January 2006, everybody in this room, including me, has the opportunity to do terrible math. And that is, we are bound at TSP as a defined contribution plan by the elective deferral limit that the IRS sets for every tax year. Last year was 17.5. They did not change it. It's 17.5 again this year. DFAS will firewall you at 17.5. They won't send us any more money for the elective deferral contributions. That is the limit for everybody in this room. If you turn at least 50 in this calendar year, and I think I'll talk a little bit more about this, then if you are planning to get to the $17,500 by the end of the year, you have the option to also do catch-up contributions not to exceed $5,500. Now, I cannot choose a percentage for catch-up. It has to be a dollar amount. My elective deferral, 17.5, I can pick an even percentage or dollar amounts. If you're trying to get to 17.5 this year, how much is it? Does anybody remember? $674. And the last pay date, you come up to $4 too much. It doesn't come to us. It's left in your pay because DFAS is programmed not to let you exceed it. Now, FERS, that's almost everybody in this room. Whether I am contributing or not, if I earn any basic pay in a pay period, even if it's not for a whole pay period, I might be leave without pay or came in the middle of a pay period, my agency by law is required to put in 1% of my basic pay, which includes locality pay. So that is going in every single pay period, whether I contribute or not as a FERS employee. Now, if I am contributing, which I hope everybody is, and I hope everybody is at least at 5%. Why do we want to be at least at 5% if we're FERS? My match. Now, this is fuzzy congressional math. I get matched 4% on my first 5. I'm matched on 5, but they give us 4 because it's 1, 2, 3, half, and half. My match is 4, I contribute 5, and then this other piece is that agency automatic 1%. It's in a separate bucket. And this is in a separate bucket. That's why everybody says I get, matched on my first 5. I am matched on my first 5, but I'm matched 4. This comes in. It's still, if I'm doing 5, I'm doubling my money for free every pay period. The IRS does not see this money going in. They only see mine. So if I get to 17.5, they still don't see this going in. This is coming in tax deferred. Everybody understand the difference between deferred and FREE? Deferred is not free. It means down the road. It's all of my contributions, unless I've chosen the Roth option, and my agency contributions are tax deferred. From ordinary income, they will be taxed as ordinary income, federal and state, if applicable, and when they become a taxable distribution somewhere later in my life. So Each pay period, I contribute 5. My agency is putting in the 4 and the 1. Now, who's been here less than 3 years? Anybody? Less than 3? You're it, sir. Okay, he's been here less than 3 years. If he leaves in less than 3 years, everything else being equal, except for special appointees in Congress, if he leaves before 3 years, he doesn't get to take this 1%. He gets his with positive or negative earnings. He gets his match with positive or negative earnings, but he doesn't take this. And that's why our expense ratio is net, because if he leaves before 3 years, this 1% forfeits to the TSP to help decrease everybody's expenses. So you stay 3 years and a day and you're okay.
Why did you say you're welcome?
You need 3 years in this agency or 3 years?
No, 3 years creditable service. 3 years. The problem is, how many of you work for another agency? Anybody here work for another agency? Sometimes when you leave one agency and go to another, this is something you always need to check, not just TSP. Because let's say this gentleman asked the question, do I have to be at an agency for 3 years? That's not, no, it's 3 years. So, let's say this gentleman leaves in 2, the one I picked on. He does not get to keep that 1%. He comes back in another time frame. And he stays for another 2 years. What he forfeited from that 2 years, he never gets back. But 2 years plus 2 years, whatever he gets 1% in that second stint, he gets to keep because he's got 4 full years. Now, if you go from one agency to another, you need to make sure that your agencies have talked to each other and given you all service credit, not just for TSP, but for everything else, for your retirement, your pension, and everything else. Always check it. And you can always see that on your annual statement, because if you're FERS, it says TSP SCD, that means TSP service computation date, 3 years from. And if it doesn't look like it includes all your service, you need to speak to HR and those folks, because we can't help you with that. We don't have your personnel records. Your agency currently does. So always check that to make sure those are clear for you. Okay, now, I have some folks that start out and say, I can't do 5%. I can't do 5%. You know, I got auto-enroll with 3. I'm going to take a deep breath. I'm going to keep the 3%. But the key is on the 5%, when I started out, I was GS something under this chair. I don't even know if they had a rating. But the bottom line is, I know the last 3 years we haven't looked at something called a raise. But so far, step increases and promotions have not been stopped. So when you get a step increase, you get a promotion, it's generally at least 2%. And so when I first started out, and even now, I say 1% for me, 1% for my TSP. I get to reward myself for that step up, or whatever it is, and I get to reward myself hopefully for the future. So that's maybe a time to do it, because at some point, a lot of folks may say, I need to be doing 10 and I'm only doing 3, but I can't do 7 more, so just forget it. It's a little bit at a time. Whatever is going to work for you. We've already talked about the match. Hopefully that is helpful for everybody. Now, in the law, this is not a TSP rule, this is not an agency rule, it's in the FERS Act. It says that we are matched on the first 5% per pay period. So if you look at these two folks, it is, bottom line, you've got Ed and Susan. So you've got 2 people who are both going to do the 17.5 this year. Just make the assumption. Going to do the 17.5. Ed decides to try and max out early. They're both FERS. They both have the same basic pay. So they have the same match. It's on 5%, it's 4% on the first 5 for each pay period that they're contributing. Ed maxes out in pay period 18. How much more can he contribute this year? 0. On the elective deferral limit, he's done. He's already gotten match on the full 17.5, which is 4% of the first 5 each pay period. Now, Susan chose the 674 that we talked about before, and she's doing it all the pay periods. Notice the difference in her match. Because pay period 19, be very careful what goes in Ed's TSP account. What goes in? Careful. 1%, whether he contributes or not. But he left, look how much money he left on the table. He can't go back and tell MyPay or DFAS, whoops, I did bad, remember I said we could all do bad math? I did bad math, spread this out. Nope, it's not your agency error, it's not your payroll error. But you won't do it again. And every year about September, we have people that max out. And so be very, very careful because you don't want to leave that money on the table. Now, anybody in here who is actively contributing to a uniform services side of the house? Nobody? Okay, so we'll pass on that. If anybody has uniform services questions, we'll be glad to address those at the end. Catch-up contributions. Now, everybody's on the same sheet of music, whether you're CSRS, offset, or FERS. Everything here forward, we're all the same. The year in which you turn 50, you may be able to financially feel like you could begin to do some catch-up contributions. Now, let me ask this, and I know I don't expect anybody to come to the microphone. I'll take your answers and I'll say them out loud. What is the point of over 50 catch-up? We know what it is, but what is the point of over 50 catch-up? And I know I have at least one person besides me in here over 50. Anybody? It's what?
Lower income, less taxes that you pay on it?
Maybe lower your take-home income if you're doing traditional, so you have less taxes to pay. But what is this magic over 50? It's a coulda, woulda, shoulda. Those of us who are at least 50, I'm seeing a lot of this. Those of you who are 25 and 30 are going. But those of us who are over 50 at 25 and 30, what did we think of 50-year-olds? We're not going to ask the 25 or 30-year-olds because usually they don't think we're very wise. But when we were 25 or 30, we didn't, you know, old, rich, or dead. And if we're sitting here, we're none of the above. So this is kind of, yeah, it's a catch-up. It's a coulda, woulda, shoulda. When I was 20, you don't go back and do any math. This is annually something you're allowed to do. This is that once I get to be 50, maybe the kids are gone, I bought their cars, I've stopped buying houses, I changed the locks so they're not coming home anymore. The usual stuff. Now it's me time. Because once I get to be 50, I need to start taking care of me. How many of you want to go live with your kids? You know, this is a great incentive, I think. But the bottom line is, now you may have more disposable income. It may be a tax strategy also. But the key is that if you are planning to get to the 17.5 by the end of the year, you can simultaneously, you have to sign up for it separately, through MyPay, simultaneously have deductions taken out of your pay not to exceed an additional $5,500 this year. Now, everybody's on the same sheet of music because there's no match, there's no 1%. It's a gimme. My challenge is if I'm over 50 or that year, I have to remember to sign up for this every year. My elective deferrals just keep going unless I change. This, I have to sign up every year, and I can start, stop, or change this at any time. So if you're planning to get to the 17.5, then you could start this now if you haven't. There's no such thing in your payroll, DFAS, or TSP that's playing catch-up police. By that I mean, let's say you're planning to get to 17.5, and I'm going to pick on this lady and make her at least 50, and she's going to plan to get to 17.5 by the end of the year, but she's FERS, remember, she's got to have that 5% every pay period go in. So when she gets the last pay period of the year, she's maxed out on the over 50 catch-up. She's already done the 5,500. But she's only got $16,000 going in as elective deferrals. All the IRS cares about is she does not exceed $23,000. That's all they care about. So nobody's going to come back and say you can't do it. You can do it every year. You can do parts. You could do 2,000. You could do 200. You could skip a year. It doesn't matter. It's any year in which, beginning in the calendar year, you turn 50. So if you don't turn 50 until December 31st, you still get to be able to do it that entire payroll year. Okay. Most of us are still having all of our contributions come in tax deferred. How many of you have chosen the Roth bucket with TSP? We have a few in here. The rest of us, everything's coming in tax deferred. So the portion that you are tax deferring coming in from your basic pay, and most of you have done your taxes, right? The few of you who haven't done your taxes mean you probably still owe, right? Because we're going to wait till next Tuesday at midnight, whatever time the post office is open. But the bottom line is that if you looked at your W-2 this year, no matter how much you contributed to TSP, if it is tax deferred money, it adjusted your gross income before almost anything else is going to adjust that. So it decreases your taxable income because you are decreasing it from ordinary income. You'll pay taxes as ordinary income when it becomes a taxable distribution. It is also state tax deferred unless you are in Pennsylvania or New Jersey. And right now they do something up front, and I can't address that. Talk to a tax person in Pennsylvania and New Jersey to figure out what kind of records you need to keep to verify that as you go down the road. So most of us still have tax deferred money coming into our TSP account. I'm giving this very brief example. It's probably not you if you've already done your taxes, and other folks have already done their taxes. It's just something to put back in your mind. IRS came up with this option in 2002. This is somebody who's a moderate wage earner. It may not be you. It is not just for TSP. It's for any defined contribution plan. 401, 403, 457, some of the other ones. It's a tax credit. It's called the Saver's Tax Credit. Most of you probably have not. How many of you have heard of this? A few of you have heard of it. You may not qualify for it, but 80% of the people who qualify don't even use this option. Not only do you get the tax deferral, so if you earned $50,000 last year and you contributed 10% to TSP, you had everything else being equal with no other adjustments, you're only going to pay federal taxes on, or a tax bracket for $45,000. This is available for moderate wage earners, and you all know somebody who is, even if it's not you. And this is something we suggest that folks look at for this year. You can see each of the filing categories. There's a phase out, and we use the first amount here. And if this person contributed up to $4,000 this year, the maximum credit they could get is $1,000. What this means is if this couple is married filing jointly and they owe $500 in taxes, even though they're moderate income earners, that $500 is wiped out. They decrease their taxable income by $4,000 already. They wipe out the $500. They don't get a refund of the additional $500 up to the $1,000, but they wipe out their federal taxes. You cannot use a 1040A to do this. Okay, Roth. I need to see if I have something with which to write. Yep, I do. Okay. Now, let me walk through a couple things on the Roth information. Let me stop here first. I don't know if they're going to unmute the phones over here. Does anybody have questions so far on contributions? Good? Okay. We'll move on, and then we'll take some questions at the end of the Roth because we have several slides here, and hopefully this will answer some of your basic questions. And additionally, this booklet that most of you picked up out there has additional Roth information in there too for you. And there's a lot more on our website, and there are some short videos available on the website also that give you more Roth information out there. So, a couple of things. This allows me to designate through my pay a portion or all of my contributions, if I wish, to be going into the TSP Roth bucket. Now, this is not a Roth IRA. This is part of your Roth employer plan, so the rules are somewhat different. This is not a separate TSP account. Those of you who looked at your annual statement, you have employee traditional bucket. Even if you're CSRS or offset, you have a Roth bucket. Those of you who chose no Roth contributions, that bucket is all zero. But it's all in the same account. FERS, you also have the 1% bucket and the up to 4% for the match bucket. So it's all the same account. It is not a different investment option. If 40% of my contributions are going in C fund and 60% are F, and I'm doing some Roth and some traditional, it's going to be proportional into C and F. Everything is proportional. Now, Roth means, for those of you who honestly, have not looked at this, this means that those contributions, I am telling DFAS, I'm paying the taxes this pay period on that contribution, and I will never pay taxes on that contribution again. And we are keeping that accounting. That's why it's in a separate bucket for you. Now, how many of you do have a Roth IRA? Okay, that's a whole different animal out there. And we do have a chart in here that hopefully will give you a little bit of a difference on it. Now, the key is, if I've not chosen anything to go into Roth or only part of it, the rest of my money is going in tax deferred, 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 okay? This Roth contribution, I will never pay taxes again. However, that first sub-bullet says my Roth contributions may accrue tax-free earnings, and that's the key. And it's an IRS issue, it's not a TSP issue. We have to keep the accounting for you, but the IRS says these contributions may accrue tax-free earnings, and we will get to that. You do this through MyPay. Be very careful. I have seen some people, even not necessarily where we came and briefed or anything, but some of you are doing 674. I'll give you the worst case scenario I saw. This gentleman is doing 674. Yes, he is. He just agreed. He's doing all traditional. He goes into MyPay and he says, I want to do 674 Roth bucket. Guess what he forgot to do? He didn't zero out the 674 traditional. That's the one time DFAS did exactly what he told him. And then he comes back and he says, through DFAS, oops, I didn't have any, I had $20 in my pay or 200 or something. So be careful if you're mixing and matching, make sure that the math is correct because it's what you tell them to do. Okay? Now, currently, and you're going to hear me use the term currently a lot, it means I don't know what the future is, so don't ask me. Don't go, well, does that mean? I don't know. Okay, but the bottom line is currently the traditional money in your TSP account cannot be moved in plan conversion and put in the Roth bucket. Traditional is traditional. If you want anything in the Roth bucket, it's future contributions or whatever you've already chosen for Roth, and that's the current guidance. Okay. I like this I don't know where we got this question from, but I had somebody who said, well, I'm contributing $200 a pay period. That's fine. Hopefully it's at least 5%. So you mean that I can't do 17.5 traditional and 17.5 Roth? And I said, $200 a pay period times 26 pay periods doesn't even come close anyway. But the bottom line is, remember, this is a tax treatment of your elective deferral. It is not how much you can contribute. Okay, so total, I can only do 17.5 between the two, this one, or together. Same thing with my over 50 catch-up. I can choose to mix and match that also, but the total on the over 50 catch-up is still $5,500. So the most I can contribute to this plan this year is going to be $23,000 if I can afford to do so, and I'm at least 50. So that's the limit. Yes, ma'am?
So is there a benefit to doing Roth?
I'm getting there. Okay. Is there a benefit? Definite maybe. It's a tax decision. Most of you have already done your taxes this year, and if you haven't chosen the Roth bucket, but you think it might sound like something you'd like to do, it's really something you should talk to a tax person about, or sit down and crunch some numbers, because everybody's different in this room. And we will look at this. Now, remember I said your earnings may be tax-free. This is a consideration for everybody in this room. May be tax-free means the IRS has two rules. The first one is I have to be 59 and a half, disabled or deceased. That's one. The second is I have to have this bucket for 5 years. And it's an and. Notice at the end of the first line it says and. So what that means is that statistically most of us are going to have to be 59 and a half. Because disabled is not OPM disability, it's Social Security / IRS, and they tend to be more strict. So statistically, most of us are not going to be disabled. Statistically, most of us are still going to be breathing at 59 and a half. So when I say 59 and a half, that's the general rule. I've got to be at least 59 and a half, and I have to have this money. My contributions, remember, I'm not paying the taxes on the contributions, but whatever that contribution earns, for that money to be tax-free, I have to be 59 and a half, disabled or deceased, and I have to have that money in there for 5 years. Now, here's what the IRS says about that, and hopefully I can write this big enough so some of you in here can see this. But the bottom line is, who actually started putting even $10, it doesn't matter, I don't need to know how much. Who put something in your Roth bucket in 2012 when you could do it? Right over here, this young lady here. All right. Remember the first payroll offices, and not all of them came online in May, but the first time she could have done this was what? May, June, July, something like that. So let's say she put this in, pay date 1 August 2012, and she put $10 in. Might be 1% of her basic pay, or she chose $10. That's all she put in 2012. 13, 14, 15, 16. How many years have we got on this chart? 5. This is all she ever put in there. Guess what? 1 January 2017, she has met the 5-year rule. She doesn't have to start over. She doesn't have to put something in every year. Her 5 years is done, says the IRS. And the IRS also says she gets credit in 2012 all the way back to 1 January. She met the 5-year rule. So what we have folks do or tell us, you mean I can put in one deposit, one something in Roth this year, and I may not see my tax man for another year, but I will have credit for one of this 5 years by putting in something in a tax year. So you're in year 3 already, even if you don't put any more in, okay? She always is going to get the earnings off this, but the key is she going to have to pay taxes on the earnings, or will it be tax-free? She met the 5-year rule, but since she's only 30, she's got another 30 years to go before she meets the 59.5 rule. So again, I have some older participants that say they want to use this as a tax advantage. They're going to meet the 59.5. They're over 59.5. It's when are you going to start touching this money, because up until the first 5 years, if this money starts coming out, it's going to, we know that right now her earnings on this, if she were eligible to take that $10 and she had $2 of earnings, not counting anything else, this is going to be taxed, that $2 is going to be taxed as ordinary income, because she hasn't met the 5-year rule or the 59.5 in this case. So you kind of have to look at those things and make some decisions. But she can still do the withdrawal if she's eligible. And that's the key. Most of us in this room are not going to be eligible to do this. But we keep the accounting on this. And for right now, the $2 earnings in that is in her traditional bucket. She's got the earnings, and it's going to keep earning as long as it's in there. And once she hits the 59.5 and the 5-year rule, the earnings that are pegged to go with that $10 move over into the Roth bucket. It's a massive accounting issue. Ma'am, you're going to probably have to get the microphone because I can't hear you. I already know. So if somebody has a microphone they want to hand you, but can I wait till I get to the end of the Roth stuff? Okay, and then please ask. Okay. Earnings, remember, are going to be taxable, and if anything, if you do early withdrawals, you may have penalties, which would be included on this. We picked 2 people here. We did an all or nothing. We didn't do a mix and match. We did an all or nothing. We said Mike and Ike. Mike wants his tax break now. They're both contributing $2,000 to TSP. He wants a tax break. He's paying $500 less in taxes than Ike. 20 years from now, what's going to happen to your tax? You may have less income, but what's going to happen to the marginal tax brackets? Does anybody think the tax rates are going down? Okay, so I may be earning less, but my tax bill may still not be a whole lot less. It may even be more. So that's a consideration down the road also. Now, 20 years from now, if nothing changes, which it probably will, he still actually owes more because he's got the earnings and the original $2,000 on which he's paying this. Now, this chart is hopefully helpful for some of you. You've got Roth IRA, which is your bank, your credit union, your brokerage house, your financial person, has nothing to do with TSP. You've got Roth employer plans, which includes TSP. And notice the differences. There's a couple of things. First of all, Roth IRAs have income limits. That's another reason you're talking to a tax person, especially if you're a high wage earner. We don't care in employer plans, says the IRS, how much you earn, what you are eligible to contribute can go into a Roth bucket. There's no income limit. Contribution limits are separate and different. Separate and different. You don't subtract one from the other. Now, there's something called a required minimum distribution on employer plans. Once you separate from service, there's an age at which you have to start taking money out of these employer plans, and we'll get to that in a little bit. But the bottom line is, if I have a Roth IRA out in the private sector, I could live to be 150 and never have to touch the money under current IRS guidance. I don't have to touch it. If I've got a Roth bucket in my employer plan, which includes TSP, I will, at this point, have to start taking it out when I meet certain requirements, one of which is an age requirement. Now, IRS says that if I have a Roth IRA with Bank A, I can move it to brokerage firm C, and it would still be a Roth IRA if everything transfers correctly. If I have a Roth IRA, I cannot currently move it into my employer plan. IRS does not allow it. It's not a TSP rule. When I'm eligible, the Roth bucket in my TSP could be transferred to a Roth IRA, and again, it's going to be a while for most of us to be eligible, or to another employer plan that has a Roth bucket. But Roth IRAs cannot come into an employer plan currently. Okay. Questions still, young lady? You may just have to shout.
Okay, can you hear me now? Why don't I shout?
Shout, and I'll repeat it.
My question was, if, you said about the 59 and a half, if you know you're going to retire before 5 years, does that mean you can't do the Roth IRA? And I think that's kind of what you're getting at.
No, no. First of all, I'm not talking about Roth IRAs, I'm talking about Roth in your TSP. Okay, so suppose you're going to separate from service. Remember, we don't use the term retire, we use the term separate. If you're going to separate before 59 and a half, that does not mean you cannot do this. Because we have older participants who are looking for those earnings to be tax-free, because they meet the 59 and a half. Now, if you separate before then, if you are not going to touch your money for a while, or even if you do, say you separate at 60 and you've been contributing to the Roth bucket for 3 years, and you decide to start doing some sort of withdrawals from your TSP. You still have 2 years before those earnings are tax-free, but they're coming out proportionally tax-deferred for 2 years. And if you're still getting payments from TSP after 2 years, remember you've already met the 59 and a half rule. Now the remaining earnings on that Roth bucket money go from tax-deferred and move into the Roth bucket at that point. And a lot of folks who are older are saying, you know what, I'm not even going to touch my money for a while, so I'll meet both of those requirements. I'm not saying don't do it. I'm saying consider it, because it's a tax issue for a lot of people. And time-wise, for those of us who are older, is it going to be in there long enough to earn, tax-free earnings before we have to touch it? So yes, everybody, that's why I say it's a tax strategy, it's not an investment strategy, and you really need to talk to a tax person, because it's how you tax advantage monies that you're going to be getting when you separate and have income other than earned income. Okay, I'm going to run out of time. I need to keep going. Okay, transfers and rollovers. Let me ask here with a couple of you, transfers and rollovers. Yes, ma'am.
Can you get a TSP Roth? Can you get a Roth Roth outside of the TSP program if you elect the Roth in the TSP program? That may not be an appropriate question for you. I don't know, but.
Can you have a Roth IRA other than a Roth in your TSP bucket?
Yes. Yeah. I mean, yeah.
Maybe. Because there's different rules on the Roth IRAs. That's why you need to talk to a tax person. Okay. Remember I said we're active, separated, and deceased. One of the three. I am eligible under Internal Revenue Guidance to transfer qualifying money into my TSP account, whether I am active or even after I'm separated from service, if I wish to do so. And eligible money is determined by the IRS. We have a form, and you may have a traditional IRA, you may have an old employer plan that you'd like to transfer in. Now, when we talk about transferring in or out, whether it's TSP, whether it's a bank something, whether it's an IRA, whether it's another employer plan, this is something I always say is find out if I'm moving money in or out of somewhere, how much is either custodian going to charge me, if anything, to move my money. They may say zero, it may be a dollar amount, it may be a percentage of my account balance. It doesn't make it good or bad, it's just, is it going to cost me something? Now, for those of us who are sitting here, let me ask this question. One of two times, when does your TSP account expire? And don't give me an age or a date. Any idea? One of two times your TSP account expires.
When you die.
Death. Separation is not correct. Separation is not correct. And I know that people tell you this all the time. Your TSP account and mine generally is only going to expire one of two times. The first is sometime after I separate. I did not say when. I said after I separate, and I choose one or more of the full withdrawal options, and I zero it out while I'm still breathing. Now, although I can no longer contribute, it is still earning, and I still get to move it among the funds. And I'm paying the same expense ratio, whatever it is, for each of those years like we did last year. It's all the same. Remember, because the only fee is when I take out a loan, and I have to still be active to do that. Now, the only other time my account is going to expire, and this is recorded, so hopefully you hear me right, and if you don't, you can go back and listen to it, is when I do. That means until I die, and everybody in this room, until you die, you could have money in your TSP account. It's earning positive or negative, and when I say it expires, because it's a defined contribution plan, it's going to remember that somebody you know or love, or somebody's, or whatever. You have beneficiaries. But the account expires because you're expired. Okay? But the money is going to, again, somebody you have chosen or by statute. So the key is, even after I separate, as long as I haven't zeroed out my account, I could transfer money in. Now, hopefully you guys are using this. I will tell you that in the not too distant future, I already know that, how long is your password on MyPay? And you change it what? Every other hour? Well, we at some point this year are probably going to more secure passwords also, so just, I don't know. I know, we're not supposed to write them down. Let me just leave it like that. But except for your personal account, everything on this page is public domain, so if you have a financial person you're working with, a tax person, you can get everything off here. To contact us, I think I picked up, this is something you probably want to keep somewhere. I know a lot of the big papers, they tend to get lost, straight or stolen. But go ahead and, if you call this 877 number between 7 a.m. and 9 p.m., Monday through Friday Eastern Time, and you punch number 3, you'll get a TSP rep live in the United States to talk to you. Okay.
Is that a Fed or a contractor?
Pardon me?
Is that a Fed or a contractor?
They work with TSP. They are TSP. Okay, diversification. 40% of you leave all your money in the G fund. How come? How many of you who are FERS would like to eat when you separate from service? TSP for FERS is 30 to 50% of my income after I walk to make me equal to the folks in the old CSR system. And if I have everything in G fund, it does not keep up with taxes and inflation. That's the short answer. Does not keep up with taxes and inflation. So you may want to Every once in a while, we send out notices to say you're all in G fund. You know, if that's what you want to do, that's perfectly fine because you may have other investments, but keep in mind that it may not get us where we want to go. We do have 5 underlying funds, GFCS and I. We have the 5 L funds. Some of you look at the L funds and think they're very different. In some ways they are, but what are the investments in the L funds? What investments are in the L funds? GFCS and I. So you've already got those 5. They are professionally managed portfolios. They rebalance every day, and they reallocate a little more conservatively every quarter except for the L income fund. Now, the G and the F funds, the G fund has never had a negative return. Why? Because government has not defaulted on a loan. Okay. F fund is also relatively stable, but you can have a negative return. They tend not to be volatile, but you can have a negative return because they're bond funds. You've got the 3 index investment funds, CS and I, that are equity stock funds. We, by law, cannot have individual stocks and bonds, and we will not add any funds until Congress gives us guidance to do so. They drive that train. If you separate from service and we add an XYZ fund, whatever it happens to be, remember, as long as you have money in TSP, you can move it among the funds. You could still move money into any additional funds that we add at some point. Okay, but right now, that's why we have what we have. And I think they probably have other stuff on their plate right now. So, April 1st, a lot of folks, you know, have been sitting on the sidelines for a long time. This month we've been kind of doing this. But last year, the 3 equity funds, C was almost 22%, S was 25.5-ish, and the I fund was 17.94. And if you want exact, there is a 2-page formula out on the web page that if you can't sleep at night, you can do the math. This is after all expenses. So this kind of gives you an idea where we are. The C fund mirrors the S&P 500. Anybody, well, we're down in DC, and I can't get that radio station up here, but there's a radio station that on the half hours, on the 25s and 55s, on the half hour, they tell us what the market did. And the one that 25 after 4 you listen to, you hear the Dow, the NASDAQ, and the S&P 500. I listen to the S&P 500 because if you have money in the C fund, if it had a great day, because we're daily valued, tomorrow morning, even if you didn't have any contributions come in overnight, the share price has probably made you happy. If the S&P did this, you may not want to look at it tomorrow. Remember, this is a long-term investment because we mirror it. We don't have the option to pick and choose in the investment categories we have. Now, I don't know if this helps, gives you an idea. Not necessarily. The 3 biggest bouncy ones are the CS and I funds, equivalent since 1987. But if you look at that orange line, you see $401. That's the C fund, the G fund, since 1987 till the end of 2013. That's a long time. It has earned about $300, but inflation has eaten up a good portion of that. So that's why a lot of folks diversify, look at diversification. A lot of folks look at the L funds and they say, do I have to do L funds? No. If you rather manage your own, that's fine. There's no additional fees on these L funds. They're all part of the expense ratio. And you can pick these. One of these is how they're basically designed if you don't want to go into GFCS and I separately. You can move in and out of these and go back to the underlying funds if you so wish at any time. And notice that the 2050 fund, and these are all out on the web page, and you can make them move every quarter to see how they do, how they are projected to be percentage-wise. The 2050 fund is over 80% in equities. Why? Because those are generally people that are not going to need money for a while, and you can take some bigger bumps in the road. The 2020 fund is closer to 50% in G and F because those are considered less volatile and you're getting closer to using your money. And all this is showing is the further out you are, you can expect long term, again, you cannot predict the future, a higher rate of return, but you are also taking much higher risk. And that little tiny orange one is G, so the further out you are, the less G there is. Notice as you get closer to maybe using your money, this has rebalanced and reallocated quarterly for you until you are pretty heavily in the most stable of the investments. And that's kind of what the L funds are looking at. Contribution allocations and interfund transfers, I want to do this really quickly. Everybody's first contribution went which fund? G. Why? Congress says so. Currently, that's where it is. Okay? Now, contribution allocation is where do you want money that's not already in your account to go? So this gentleman sitting right here in the white sweater has all of his money going in the G fund, and he goes into his TSP account. This is not how much he's contributing. He tells MyPay how much to contribute. He tells TSP where he wants the money to go. So he says, all my future money, I want to go 50% F and 50% C. That's $100 a pay period for this example. So next pay period, $50 F, $50 C. What happens to the money in the G fund? Stays, because he didn't say to do anything with it. So now he's got money in the G, F, and C. He goes into his TSP account. He can do this on the web, or he can call those people live at that call center and talk to one of our participant service reps, and they'll help him do it. As long as he does it before noon on a business day, because again, we are an investment trust. We're not a mutual fund or a day trading type of operation because of being a retirement plan. He goes in and he tells them, or he does it electronically, and he says, I don't want any more money in G, F, or C. Move all my money. I want all my money in S and I. So at close of business that day, all the money is gone out of G, F, and C, and it's 50 in S and 50 in I, because that's what he said. That's fine. What happens when his next contribution allocation comes in? His new money, where does it go? He just told us move everything out of G, F, and C into S and I. So what happens to the next $100? It still goes to F and C because he didn't change where new money went. It's two separate processes. It doesn't matter to us how you pick and choose and what you do, but just be aware that it's two different things you can do in your account. Now, we do have a limit on interfund transfers. At the beginning of April, you had 80% G and 20% I. Sometime between April 1st and today, you decided that you want everything in the G fund. This is the money that's already in your account. So you move 100% G. That's your first interfund transfer. You get another one where you can move the money wherever you want. Now, I don't have the L funds here, but you could move it to the L funds. I've only got 10% left in G. Those are my two unlimited transfers for the month. Now, after this, I can always move part or all of the remaining balance, that other 90%, back to G, but that's the only way I can move money for the rest of the month. So notice the next time, all I did was increase G. The system will not let me increase or move anything else. I can still increase it because I'm not at the end of the month and I'm not 100% G. I can move throughout the month to G after the first two unlimited. The first one where I moved 100% G is counted as my first unlimited. Okay. Now, when you looked at your annual statement, even though this one I think says quarterly, up where it's redacted, make sure your name and address are correct. And over here where it says participant information, make sure that that's where you can find your account number. How many of you have no idea what your password is, so you can't get in your account? We don't know what it is either. It's encrypted. So you would have to call those folks or go to the home page and plug in your account number. And we are still mailing to your address a record an updated password. We don't care if you make it match others, but we will never ask you for a password. If you call us, they may ask for your account number, but they'll never ask for your password. Up there, it has your date of birth, your retirement system coverage. The gentleman in the blue shirt over here that asked me about total service time, that's where you see where it says something about employment status active, separated or deceased, and service required for vesting. And it's got a date up there. And then the next one is your transaction detail by source, because that tells you if you've got money in that Roth bucket, if you've got money in traditional. Has your agency put in 1% every single pay period? Have they put your match in for every pay period that you were eligible? So you've got all of that stuff. So you should be able to see this on your quarterly statements. The only one that we guarantee that we're mailing right now is your annual one. Your quarterly ones you can see online. And if you've had an account long enough, you can go back to third quarter 2003 and see your account, your quarterly statements. If you can't see them or you can't get into your account, if you call those folks, they will get them printed and mail you copies. Okay, we do offer loans and we offer in-service withdrawals. We offer two types of loans. IRS drives this train pretty much, so be very careful if you borrow from your personal TSP account. We have a general purpose loan that whatever you want to borrow it for, please don't call me. I don't care what you want to borrow it for. The other loan is a residential loan for the purchase or construction of a primary residence, and it does require some documentation. You can only borrow from your account while you are actively employed. You cannot borrow after you separate. Minimum repay is a year, and you do this through payroll deduction. DFAS will deduct whatever you agreed to repay in the loan agreement. General purpose loans may not exceed 5 years from the date of disbursement, and residential cannot exceed 15 years. Now, this is where we have the processing fee. So if you borrow $20,000, we're going to send you $19,950. You'll repay $20,000. You will repay it with interest, and the interest is based on the G-Fund rate of return in the month in which we process the loan. So it sounds very inexpensive, which a lot of people say, oh, yippee, I'm going to do this. But we have a lot of possible issues here, and one of them is the whole time that $15,000 is out, even though you're repaying it with interest. I had a gentleman tell me the other day, he said, can I write a check and finish paying off my loan, because I can earn more money than I'm repaying myself every month at 2-point-something% by moving it, whatever. This is the one time you can write us a check or send us a money order or do something that does not bounce. And you can send checks, money orders. We have a loan repayment coupon that comes in with it. You mail that to us. We do not take EFTs for these things. And you put your loan number on it, and it will decrease the amount on the loan, or it may pay it off if that's what you're trying to do. You can always get a loan payoff from us. But there is that big invisible cost. The other cost is a lot of participants, especially back in 2006 and 2007, when the housing market here was not doing too badly, and everybody thought they were going to sell their house here. So they took out loans, and some of them were TSP loans, to build the dream house in the next, some other state or something like that. They were going to sell this house. Guess what happened? We already know it flattened out at least. It didn't really go down that much, but it flattened out at least here. They separated from service, and the rule is that within 90 days after separation, the loan balance is due in full. You cannot take the loan into separation with you. You can pay it down. You can say, I intend not to repay it, But most of the money in our account is tax deferred. I borrowed tax deferred money for myself. So if I say I'm not repaying it, what happens to that money? We have to tell the IRS it's a taxable distribution, and you will owe federal and state taxes, if applicable, on that loan balance in whatever tax year the distribution is. So be very careful. We do offer two types of in-service withdrawals. We have a financial hardship in-service withdrawal, and we have an age-based. We have a separate booklet on these. Be very, very, very careful if you decide to do an in-service withdrawal, especially financial hardship. Because financial hardship, the IRS has very strict rules on these also, and this money can never come back into your TSP account, so it's gone. Financial hardship becomes a taxable distribution, federal, state, and if you're too young, it could have an early withdrawal penalty tax. And financial hardship rules, the IRS says if you take out a financial hardship, withdrawal, you may not contribute to this plan for 6 months. So if you're FERS, what happens if you can't contribute? No match. And you currently have, it's in your court, we send you a letter, but you have to go back out to MyPay to sign up again. So there are some issues here, be very careful. Now there is an age-based in-service withdrawal if you're still working at age 59 and a half. You are eligible to do a one-time partial withdrawal from your TSP account. And I'm using the term partial withdrawal also because you only get one partial withdrawal one time out of your TSP account under current guidance. So if I do it while I'm still working, and it's an age-based in-service withdrawal, I am able to do it now, but when I separate, I don't have the partial withdrawal option currently when I separate. So, if you are at least 59 and a half, that partial withdrawal can go to a qualifying plan or maybe a qualifying IRA. You may be able to then continue to tax defer all or part of it because you want to invest somewhere else, you want to emergency fund somewhere else, whatever you want to do to tax defer, or whatever you touch, you will pay federal and state taxes, but because you're at least 59 and a half and still employed, there's no early withdrawal penalty tax. So there's a lot of information up here. Look very carefully at those. Okay. When should you start withdrawing your money? You do not have to start withdrawals when you walk out the door. Nobody does. And I think a lot of us have some issues with that because you turn in paperwork and say, yeah, I got to start doing something or I got to take my money. We already knew you don't have to. And you don't have to start the day you walk out the door. First of all, you can't touch it the day you walk out the door because DFAS doesn't tell us generally for 30 to 45 days that you've walked. Once they tell us, we will send you a notice that says, congratulations, we know you separated. As long as you don't have an outstanding loan, that will stop any withdrawals until that 90 days or you do something with that loan up to 90 days. How long does this money have to last? How long does this money have to last? How many of you have families with short lifespans? Anybody? No? We're all going to live to be 100? Guess what? Oh, this lady has short lifespans. You know what? My mother-in-law told me that, and she fibbed. But, you know, a lot of it, she lived to be 98. And she said, everybody's gone by 70. And that was true, except for her. So the bottom line is, you don't know how long this money has to last. Some of us are going to live longer in separation than we earned an income, if you think about it. Because federal employees, even FERS, if you've worked long enough for the federal government with the years and minimum retirement age, we could go out in our 50s, theoretically, some of us. And if you live to be 90-ish, you didn't work that long. So it has to last possibly a long time. Or do you have somebody or someone's or some things that are dependent on you when you walk out the door? You know, young folks right now are thinking no, you know, because they're at the beginning of their lives and the beginning of their careers. But some of us have family members for whom we are responsible, or something for which we are going to be responsible. Okay, post-service withdrawals. Once you are eligible, I'm walking through these pretty quickly. If you have less than $200 in your account, believe it or not, we have some people with less than $200 in their account, we're going to cash you out. We will not leave the balance in TSP. We're going to write you a check. You can leave your money in TSP. Now, the first time you have to touch your money, and this age is not written down, touch it. I didn't say empty your account. 2 qualifications again. Remember, Roth had 2. This is 2 different ones. Is April 1st, after the year you turn 70 and a half, and, the key word is and, you are separated from federal service, you have to begin to take minimum distributions that are determined by an IRS formula. So the 80-something-year-old I have working at one of my agencies that I see every year does not have to touch his money. Why? He's not separated. And again, I saw somebody yesterday that had some information. I said, did TSP tell you this? He said, no. He's still working. He's 74, and he said the year he turned 70, April 1st, after the year he turned 70 and a half, somebody told him he had to take money out of TSP, so he took money out. And he took a tax hit on it. He didn't have to. He's still contributing. He's still working. Now, IRA rules are different. Don't talk to me, or if you've got money left with a previous employer. I'm talking about where you are now. Now, whether you are separated or not, about 6 months before that April 1st, we're going to send you a notice that says, if you're separated, if the rules are still the same when you get there, the IRS rules, if you're separated, here are some things you can do, here are withdrawal options, but we also are going to have to start sending RMDs, and we'll have to do something. And I think we have at least 2, and we're working on 3 notices, because I figure when I get to be that old, you're going to have to remind me more than once. Okay? So, you can combine accounts. I don't have anybody here who's actively on uniform services, but if you have one, you may be able to combine uniform services with federal civilian. If you did not do an age-based withdrawal, you may be eligible to do a partial withdrawal. And a lot of people do this, and the key with the partial withdrawal is, a lot of folks say, okay, I'm walking out the door. OPM's going to send me a check. How long is it going to be before they figure out what your full amount's going to be? Months. So you get a piece of that. If you're eligible and you decide to take it, you may have Social Security, but if TSP is a big portion, you aren't sure how much you're going to need necessarily. So what you end up doing with that is, some folks then, if they didn't do the age base, say, I'm going to do a partial withdrawal, I'm going to move it to a tax-deferred, if it's tax-deferred money, I'm just using that. Roth is a whole different animal. But the tax-deferred, I'm going to move it to a tax-deferred instrument, and then I can just pick, cherry pick out of that what I need, and I'm not going to owe all these taxes up front. Then once I get my OPM stuff straightened around, once I figure out what my lifestyle is going to be, then I may choose among the full withdrawal options. And it is not full withdrawal option. It is one or more. So, let's say that for this example, and we have calculators on the website where you can plug mix and match, and you can plug one or the other way. Pretend you only have 100,000, and that's going to be it. I could say TSP, and I will go over each of these briefly, so kind of give me a minute here. I could say I would like 100% of my account balance in TSP, send me monthly payments based on either life expectancy or I pick a dollar amount. That's one. Next option. TSP, purchase me a life annuity, and all of this money leaves TSP and it goes to our annuity provider. Or I could say, I would like a single payment, and I can split this payment. I don't have to, but I can. And by splitting it, I can send X amount to, let's say, a qualifying IRA to continue to tax defer if it's tax deferred, or Roth to Roth IRA, Roth bucket. Or I could have it sent to me electronically, savings or checking account, something like that. What I touch, as I touch it is what I am taxed on. So even though I left this $100,000 here, if I got $500 a month and I started my monthly payments in July, I'm only going to pay taxes on $3,000 this year because that's all I touched. If in fact it's all tax deferred. If I have a combination of money in my TSP account, if I have traditional and I have something in Roth, if I take $500 a month, and let's say 80% of my account balance is traditional and 20% is Roth for this example, $400 is going to be taxable because it was tax deferred, and $100 is going to come, and our 1099-R, which is our equivalent of a W-2 for a retirement plan, is going to show that you already paid the taxes on that $200 in the Roth bucket. Currently, it's coming out pro rata. Loans, any kind of withdrawals, pro rata proportional. I can't say send me all tax deferred or send me all Roth. I currently cannot do that. Okay, or I can mix and match. I could say TSP, I want to leave 60% here. This is still earning, positive or negative. I still get to do interfund transfers. I could say, purchase me a life annuity with 20% and transfer 20%. Does everybody see you can kind of mix and match? You don't have to do all or nothing. I could say, I don't want anything here. I want 30% here, and I maybe want 70% here. So I can mix and match. The key is whatever leaves TSP in the Code of Federal Regulation, we cannot take it back if you make a choice that you later wish you hadn't. So take a deep breath. Plan your separation at least as long as you planned your last vacation. Because you're going to be separated a longer time than most vacations. So each of these will create some sort of taxable event. And I said event because some of this may still tax defer. If it's a Roth bucket money, it's still a taxable event because we have to tell the IRS that you don't owe taxes on it. I didn't say it created a liability for everything you do, but everything creates a tax event. And we have about 14 to 18 tax withholding categories on an 8-page form that the IRS says that we have to do this if you touch certain things this way. Now, monthly payments, you can do life expectancy, and we use IRS tables for those. If you choose a dollar amount for monthly payments, between October 1st and December 15th each calendar year, you can change the dollar amount to begin with your next January's payment. It may or may not change your tax withholding. So every year you can change the dollar amount. If you're getting monthly payments, you can always request a final single payment. You can take it, spend it, pay the taxes on the taxable portion. If you have Roth bucket, that's already taxed. Or you can transfer it somewhere else. One thing we cannot do is you're taking monthly payments, and this young man, because he didn't need to know about withdrawals yet, but he won the lottery, and if he were getting monthly payments at some point in his life and he were old enough, and has separated, he can't say stop my payments and then start them back in 6 months or a year or something like that. But you can always request a final single payment. Okay, now this is where federal employees get another place where we have misconceptions. Most of us who are career federal employees separate. How early do we separate? Age. We don't go before 55, everything else being equal. So what the IRS says, first of all, if you don't touch your money till at least 59 and a half, you don't have to worry about that 10% early withdrawal penalty tax. That's not your federal taxes, that's not your state taxes, that's that penalty tax. However, the second item up here says, if you separate or retire in a year in which you turn at least 55, you draw a big X through this page. You never have to worry about, for TSP purposes, an early withdrawal penalty tax. And I get somebody that goes, well, I'm separating at 56. What about me? What about me if I'm 56? Do I worry about the penalty? No. When can I touch my money? I can, once I qualify, once I walk out the door and I'm separated, I can always touch my money. I can touch it at 28, 38, 48, 58. It's a matter of, if I separated before 55 and I want to touch it at 48, it's how I touch it to avoid the penalty. I don't meet the 55 exception because I separated before, but the IRS, there's only 4 of them up there, but they have at least 8 more exceptions. So if you meet one of the IRS exceptions, you could possibly be touching your money. Be careful if you decide to transfer it, because if you transfer it out of TSP, you may not be transferring it somewhere that the 55 rule applies, and now you've got other issues. And we can't take your money back because you didn't read the fine print. So be very, very careful with that. So, everybody good with the 55? Everybody good with the 70 and a half and separated? Okay? So, if you walk out the door at 55, the first time you have to touch your money is 15 years later. If you don't walk till you're 83, then you're going to have to start faster. You're going to have to start now. Okay, we do have spouses' rights built in to the law, so you have to be nice to your spouse when you get ready to start withdrawals. Couple things, all of our withdrawal forms are now in what we call a wizard format, so if you go in your personal account, any withdrawal form you can fill in online. The error rate, not because of your choices, but the error rate for math and our system being able to read your stuff is almost to 0 if you use the wizard instead of hand filling it out. However, for withdrawals, everybody has to print. Married, single, CSRS, FERS, offset, doesn't matter. Everybody's going to have to print. For full withdrawal options, you're going to have to print when you finish filling this in online, because your signature has to be notarized, and married FERS, you need notarized spouse signature unless you choose the one that is set in the law, the withdrawal option. And that's one of the annuity options. Now, when you die, not when you die, when you go home, put this with your will, put it with your prenup, which you cannot use for TSP. Put it with your insurance papers, because none of those beneficiaries named there flow to us in this defined contribution plan. So I always say, put this with your papers. When you die, if you're lucky, you spend it all. Okay? But when you die, if somebody finds this, maybe they'll be disappointed. They'll call us at that 877 number, and if somebody calls and says, do you have a TSP account, the only thing we're going to tell them on the phone is yes or no. We tell them the documents that have to come in. We don't care who sends the documents with a death certificate. The bottom line is, once we verify your death, Your account balance, if it's not there, will move to the G fund to preserve it for your beneficiary or beneficiaries, whoever they are, as long as they meet, and beneficiaries can be anybody that's going to meet IRS standards. It could be a person, it could be a legal trust, it could be a charity, whatever. It doesn't matter. So we notify beneficiaries as soon as we verify your death. As soon as we find your beneficiary or beneficiaries, we notify them what 2 things in life are sure and what just happened. So what's left? Okay. Proportionally, again, Roth and traditional, they're going to get your account balances. You can't say I like child 3 better, so they get the Roth bucket and everybody else pays the taxes. It's proportional, okay? But what we do is we notify them. We send each of them a tax notice as beneficiaries, and we have 2 ways, 2 different things that are very important for folks here. First of all, if you have no named beneficiaries, it will be statutory. If you have no named beneficiaries, it's statutory. So if you want your spouse to get everything, you don't have to do anything. Your agency does not know who your TSP beneficiaries are. Those of us who've been around a long time, in 1996, when we still had paper records, we asked them to send all TSP beneficiary forms to TSP. If we tell you and you call that 877 number, that's the only way you can find out if it's statutory or if you have named names. If we say we don't have a form on file, please don't yell at our folks. That means somewhere we didn't get it. We don't care how often you fill out the TSP3, which is a beneficiary designation, if you wish to do so and you don't want it statutory. It's the most recent one we have on file as of the date of your death. So if you've got it tucked away in your important papers, when you die, we're not going to be able to take it from somebody else. You fax or mail it to us, or you leave it statutory, or you can change names to statutory. Now, we send out the notice, and we will disperse one-time payment to each beneficiary, one time only, within 60 to 90 days of finding the beneficiaries. Now, they have some options. If we don't hear anything, we're going to write them a check. So if you've got an 8-year-old, they may get a check. So provisions, you need to figure out whatever you want to do. But we have spouse payments are totally different from anybody else. In the amendment to the FERS Act in 2009, beginning in 2010, when you die, if there's money in your account and your spouse gets any or all of your TSP account, it will move to what we call a beneficiary participant account. It moves over into their name. They can leave the money there. They can move it into their own TSP account if they already have one. They can move it to an employer plan if it's private sector, if that plan will take it. They can touch all or part of it, to spend. And they could possibly, if they qualify, move it to a traditional or a Roth IRA. So spouses have a whole bunch of things. If they leave it there, there are 4 or 5 booklets that we give just to them with tax issues and all kinds of things. They can name beneficiaries should they not spend all the money in TSP if they've left it there when they die, but nobody else can leave it in there. Even if they remarry, a new spouse cannot leave it there. It's your spouse at date of death. So that's the only way it continues to tax defer in TSP for tax deferred portion to your spouse. They have rules about 70 and a half. They're treated as a separated participant, so they get all of these options, including transfers. They have the same expense ratio, and again, they can name beneficiaries. They cannot transfer money in like you and I can because it's a beneficiary account. That's for your spouse. Everybody else, kids, grandkids, nieces, nephews, friends, enemies, whatever, it doesn't matter. 2 choices for anybody who is not a spouse. I'm not talking about a charity or a trust. I'm talking about people. They either take the cash payment and it becomes whatever portion is tax deferred, is taxable at their tax rate that year that we disperse, ordinary income, their ordinary income rate, federal and state if applicable. IRS is nice. They say beneficiaries, no matter how old or how young, don't have to worry about early withdrawal penalty tax. That's great. I didn't spend my money. They don't have to worry about the early withdrawal penalty tax, but there is federal, state if applicable, their state of residence. Or there is a product that's been out there a few years that I know very little about. Bank, credit union, financial advisor, brokerage house, somebody, we don't handle this, we can't give you advice. It is called an inherited or stretch IRA. It's not the traditional IRA you currently have or a Roth IRA that you currently have. It's got that title on it because it's inherited, say, from Mom Paula. I die. 60 to 90 days. Let's say I left it to a son or a daughter, and they're 24 years old, they've got a great job, they're married, they don't need any money, their college has been paid, everything. And the portion of my account that goes to them, let's say it's $100,000, that's going to put them in a huge tax bracket. So rather than them having to take that hit, they can do a transfer. Paperwork comes to us with their request from a place that is eligible to open an inherited IRA. They can transfer all or part of it into this inherited IRA. If it were this year and this person is 24, they don't have to touch that money. But the reason they use stretch is, I think, is because next year they have to start taking required minimum distributions, but it's based on their age. It stretches over their lifetime. There's other things, all kinds of guidance with this. It's something you probably need to talk to a tax or financial person about. They can be set up in a trust, but then again, you'll need legal advice. But I can't just walk into a financial institution and open it because I'm still here. It has to be within money that's inherited from me. You have births, you have deaths, you have marriages, you have divorces. If you're on spouse 4 and you name spouse 1 and they're still named on your TSP account, these 3 can duke it out with this one somewhere else. Because I can almost guarantee this one is not going to give it up. So, be careful how you set this stuff up. Because, again, we don't care what you do with it, just make some sense with it. Now, Paulette, how do you want to handle questions? If anybody has questions, we'll take them. I guess there's some folks over here. We may have to open the phone. I thank you all very much. And after we go offline, right now we're online, but once we go offline, if you have a single question or something, come on up here and we'll try and answer your questions. Thank you. You have a question, sir?
Yeah, we're going to take a couple here, and then we're going to go to the phone lines. Okay. So go ahead.
Actually, I have 2 questions, if that's okay. The life cycle funds, at what point do they stop reallocating, if they do?
They stop, life cycle funds stop reallocating when they have rolled conservatively to get to the L income fund, and they quit reallocating there. They are fixed.
So it could be past the date of the fund, the year? Like say the 2040 fund?
We had a 2010 fund. Right. When it got to the end of the year 2010, it rolled into, and it is fixed at the L income fund. Okay. There is no more 2010 fund, and there won't be another there won't be a 2020 after that. It will look exactly like the L income fund. It doesn't go away, it just becomes fixed. Okay.
And my second question, or more of a comment, is it true that once you I'm going to say not retire, but separate, and if you choose the monthly payment option, when you hit 70 and a half, does that either offset or can it offset or meet the requirement for the required minimum distributions?
Yes. So let's say you chose, the smallest amount you can take is $25 a month. And let's say in the year you turned 70 and a half, for some reason, you were still getting $25 a month. And we had to disperse $3,600 because we know that's the RMD. And you've only gotten $300. That offsets the $3,600. We will send you an additional payment to make sure your RMD is met for the year. We make sure we do that for you.
All right, thank you.
You're welcome, sir.
I just have a two-part question. Do you have the calculators on your site? Do you have this exact calculator earnings potential of your TSP account?
That calculator is there. It's like, how much will my account grow is the calculator.
Oh, okay.
And you plug in what you have, what your retirement system is, how much you're contributing, and it will give you those numbers. And again, they're guesstimates.
The question is, because you might have changed the percentages over
Yes.
time, do you have a record of those percentages that the TSP person that I can obtain?
We never have percentages because your agency only flows dollars to us.
Oh, okay.
We've never had percentages, but when you do this, what you do is plug in what's already in your account balance, and that takes care of what you've already done.
Oh.
You're projecting forward now.
Okay.
So that will already be in there. The question that you're going to answer is, what do I already have in there?
And what your percentage is now?
What your dollar amount or percentage is that's coming in.
Thank you.
Yes, sir.
Can you switch your contributions during the year? For example, going from the traditional to partially selecting for the Roth?
Yes. Anytime.
Anytime.
Anytime. Start, stop, or change anytime. It will take effect no later than the next full pay period, and you do that through MyPay.
Thank you.
You're welcome.
Hi.
Hi.
When the beneficiary is a non-profit organization after that, how the tax payment will be made?
That's between the nonprofit and the TSP. However, we have to disperse it. We and they have ways to work that.
Oh, I see.
Okay.
Okay, thank you.
My question is a question of two non-spouse beneficiaries. If you have two or more, and one person wants to, something happens, one person wants to take part of that, because I left 50-50 to my two children. How does that work if one wants to take and the other wants to leave? Money in the...
I'm losing you here. You left half to two children.
Right.
And what?
If one decides to take most of the money, the other one doesn't
No,
want
you
it
can't.
You can't. Okay.
You can't. If they are given 50-50 and you've got $100,000, it's a one-time payment to them, $50,000 each. They can't leave it with TSP. Is that what you're asking?
Yes.
No. Only current spouses can have a beneficiary participant account. Remember, any other beneficiary who is a person, they either have to take all or part of the cash payment or all or part as an inherited IRA. That's their only option. It cannot stay with TSP.
Okay, thank you.
You're welcome.
Okay, we have one more question and then we'll go to the phones.
When you start taking money out and you choose one of these, the lump sum or the single payment or annuity,
okay.
Can you switch between those?
No.
No, you
because
pick
what
one and
happens
that's it.
What happens is, if this is a single payment, this money's already gone,
Right.
so you can't switch. If, in fact, you took a piece here and a piece here, this money moves to our annuity provider, and so it's no longer in TSP's hands. The only thing you can switch is if you want to change your monthly payments that once annually currently, and or do a final single payment. But these all go on one form at one time, and that's why I'm saying, don't turn this into us the day you know that we know you're separated if you're not really sure what you want to do, because there's no do-over.
Okay, let me see if we have any phone questions on the lines. Danielle, do we have any questions?
At this time, if you would like to ask a question, please hit #5. This will allow you to unmute your line. Again, that's #5 for questions.
Sherry. Hello?
Hello,
Sherry.
can you speak up? Yes, please speak up so we can hear you.
Hello?
Yes, we hear
Yes,
you.
hi, can you hear me? Hello?
We can barely hear you.
I can't hear him at all.
Just a quick question back to maximizing the match. And the example was the Ed and the Susan example. I just wanted to make sure. Ed was the guy that contributed like $1,000 a month for 8 months and then failed to contribute for the remaining 4 or so. And as a result, he obviously lost out on, the contribution. As long as you're putting money in, regardless of that amount, certainly the maximum amount, but as long as you're putting money in the entire 12 months, then I'm assuming that would all balance out.
If you're putting in for each pay period,
Each pay period is what I meant.
each pay
I'm
period,
sorry. Yes.
it's by pay period. So the key is if you're putting in for the maximum match, if you're putting in at least 5% per pay period, and for most of us in this room, we get paid 26 times a year. And I know you said month, and I'm not trying to split hairs, but some folks are paid monthly. So what Ed did was he did it for 18 pay periods, so that's why he maxed out so early. So if you are spreading this out over all pay dates in the W-2 year, then it's no harm, no foul, as long as at least 5% is going in each pay period, so you get your full 4% match per pay period.
Very good. Thank you. And one other quick question. What is the toll-free number?
877-968-3778, and you punch number 3 to get a live person.
Sorry.
Thank you.
You're welcome, sir.
Does the 17,500 contribution limit apply to TSP alone or to all TSP?
Hello, this is Atlanta. I have a question.
Oh, okay. I'm sorry. We got a little interference going on. Okay, can you hold one moment? Okay, go ahead. We'll take your question.
Thank you. For the uniform services, could you clarify the contribution limitations that deal with the combat zone and the 402G?
The 402G is part of the total that could come in for the combat zone, the 415C limit. It would be part of, if you were eligible, and DFAS makes that determination, if you happen to be in a combat zone this year, it could be up to $52,000. And that $52,000 includes the 17.5 402G. It includes any match and 1% that you get on the civilian side of the house. And DFAS will do that. And if you are civilian part of the year and then under USERRA get recalled to uniform services, then our system will make sure that you do not exceed either or both limits that you are allowed to contribute.
Thank you.
You're welcome.
Okay, Danielle, we're going to go back and take calls
I have a question.
here.
So, being uniform services and we get paid 12 times a year, how do we not max out as Ed did?
You get paid 12 times a year, and if you're trying to do 17.5, you divide it by 12 and come up with however much that is per month. And if you want to do that, we have a elective deferral calculator on our website, and you can go in and see how much you've contributed off your LES so far this year, or see how many pay dates you have left, and it'll tell you how much you need to contribute or can contribute to reach whatever the limit is.
Thank you.
You're welcome.
Okay, we're going to take questions here in the auditorium.
Okay.
Does the 17,500 contribution limit apply to TSP alone or to all TSP and personal IRA accounts combined?
Okay, we had a chart that was in here that shows the difference, and I'm trying to see where it is. It's right here. Okay. But there is a chart. IRA limits are separate from TSP limits. They're right here.
Okay.
Okay, so you can take that and use that as a basic reference, and if you still have questions, you may want to talk to a tax professional.
Okay.
Because they are two separate things.
Gotcha. One more. After retirement, can TSP money be transferred to a revocable or irrevocable trust fund?
Possibly. You need to talk to a lawyer about that to make sure whatever, if you wish to do that, if it fits within the guidance within your state laws.
Okay. Thank you.
You're welcome.
Hi. Once you separate from
federal service,
right now I have the ability to be able to go in and do the interfund in terms of the allocations within the interfund for the different funds. Once you separate from service, is that service provided or option available for you to still move your monies within the different funds?
Till the day you die or until you zero out your account. You can always move the money in your account. And don't forget, if you want to transfer qualifying monies in, you can also do that.
Okay. Thank you.
You're welcome.
First of all, I want to thank you for a fantastic presentation.
Thank you.
You're great. Did I hear you say the only way to find out if you have the beneficiary on file is by calling?
Yes, currently that's the only way.
So it's not on it if we go in and log in. You've got to call and talk to a live
You're
person.
going to have to call, and
Okay.
they will let you know that. Currently, that's it. We are updating that information, but it may be a while before there is another way for you to touch that for TSP purposes.
Thank you.
You're welcome.
Okay, Danielle, we have time for 2 more calls. We'll take 2 more if we have any on the phones.
Pound 5 for questions, pound 5 again for questions.
Okay, seems like we're done. Thank you all for coming. And again, let's thank Paula for a wonderful presentation on today.